This is a very important question. What is happening with the US rates, the US treasuries? Should we be dumping the US dollar? Is US dollar and US treasuries the safe haven that they used to be? RBI is correctly focusing on growth. At this juncture, we believe that there could be another 75 to 100 basis points of rate cuts. There has been such a large divergence during a risk off where Indian rates actually go the other way. They should look through the noise and invest for the longer term over a year plus. And I think they could be handsomely rewarded for that.
Lots has transpired in the bond markets, with US policies creating absolute havoc, especially in the US fixed income market. What's in store next? I have with me Tanveer Sethi. He's the investment manager for fixed income strategies with Kotak Mahindra Asset Management Singapore Private Limited. Hi Tanveer, and yes, absolute havoc in the United States bond market, with a sell-off being witnessed over there thanks to the tariff policies by the president. Could you give us your thoughts about what did you make of the entire sell-off? Perhaps just a flash in the pan and a subsequent recovery thereafter?
Hi. So yes, this is a very important question. What is happening with the US rates, the US treasuries? Typically, in the past, whenever you would have seen there's a risk of sentiment, whenever you're talking about potential recession, you would have naturally found the rates to have come off. In the near term, you could have said, yes, the Fed will not cut rates. In other circumstances, maybe even hike rates. But when you look at the longer term, you would expect the 10-year and 30-year typically to come off, because you would say that eventually this is going to lead to a recessionary kind of environment, weaker growth. So we're going to have lower rates for longer eventually. And also when there's a risk off, typically all global institutional investors will run to their safe haven, and that is they would buy US treasuries. Now, this time around, of course, that has been challenged. The trade or the theme that is going around is, should we be dumping the US dollar? Or is US dollar and US treasuries the safe haven that they used to be? So we have seen a significant fall in the dollar. We have seen the DXY go south of 100. We've seen both the yen and euro, which have appreciated more than 5% in the absolute recent past, probably 10% if you take a longer frame. But that is a sharp rise against the US dollar. And I am of the belief that apart from the potential question, the challenge that has come up, that the US treasuries, are they the safe haven or not? Also what's happening is because the currency is expected to weaken, and at that point of time, you will be hitting a mark-to-market on your dollar investments. So treasuries have also taken the hit. Investors have moved out. I don't think you are going to find a total replacement of US treasuries. You cannot, right? The other markets are not that deep. You could think of things like gold. You have to buy it as a hard asset. It doesn't have any carry over the long run. So eventually, US treasuries will find some favor with investors, but a new balance may be sought with global investors. And where that new balance will be is a good question. It will change, I think, on a daily basis the way this tariff war unfolds.
There was a pleasant surprise that came in for US investors by way of the inflation reading. However, with the tariffs coming in, how do you see that entire scenario play out?
Yes, the inflation, of course, has come off. I think even if we had looked at the previous numbers, even in January, where inflation was slightly higher, it wasn't too bad in my opinion if you adjusted for the seasonal factors, the fact that it had bad weather. But the bigger question is, does that inflation count today or not? I think this inflation coming off has got no impact from what could happen tomorrow. And there is no doubt that tariffs will lead to high inflation and probably slower growth, potentially recession as well. So I think in today's date, nobody is looking at the inflation data or today's GDP growth data as is. The question is, where will it be tomorrow? Tomorrow doesn't look good. And that sentiment, the weak sentiment, will remain for some bit. And the entire focus will be on what is tomorrow.
Meanwhile, in India, of course, there was another interest rate cut. So, with what the RBI's policies are and with the foreign news flow coming in, how are you seeing Indian yields move?
So the MPC has expectedly delivered another 25 basis points rate cut this year, taking it to 50 basis points. The important thing over here is there's a change in stance as well. They've changed the stance to accommodative. If you dial back a few months ago, we, like many others, thought that this rate cycle was going to be a shallow rate cycle. We were expecting 50 to 75 basis points of rate cuts. But since then, what has happened is the inflation number has consistently inched downwards. Multiple factors have pointed towards that. We've had relatively better monsoons. Agriculture product has been good, has been deflationary. There was a little bit of a slowdown in India's growth. That was a domestic driven. Now we are finding some potential impacts that could come from global slowdown as well. Add to that, oil prices have come off. We all know that oil is critically important to India. It imports roughly 87% of its requirement. And 10% reduction in oil prices, if fully passed on to the consumer, leads to around 30 basis points reduction in inflation. And lastly, we must not forget that China has excess capacity. If they're not going to export to the US, they are going to look to dump those goods elsewhere. There might be protection by India and other governments, but some of those goods are going to find their way into the various economies, which means overall you expect even the supply side to be further deflationary on that count. So at this juncture, when inflation is clearly under control, the downside, there are more risks to the downside than the upside. RBI is correctly focusing on growth. And at this juncture, we believe that there could be another 75 to 100 basis points of rate cuts to take real interest rates eventually to the levels of 100, 125 basis points, which would simulate growth.
Could you share some advice on how then should investors approach the Indian debt market?
So we have just covered the fact that we are in a rate cut cycle, and which is a very evident cycle. And so there definitely is a play on rates in India. The other important thing is in the last few weeks, if you see the 10-year and the 30-year, Indian rates have gone down and the US rates have gone up. I mean, I really don't recall that happening ever, that there has been such a large divergence during a risk off where Indian rates actually go the other way. Treasuries will continue to find some challenge from global investors. And in that backdrop, India is not directly comparable, right? It's an EM, it's not a replacement of a safe haven asset. But at the margin where India is looking to be in a rate cut cycle, its economy is slowing down, but reasonably one of the faster growing economies in the world. The fact that RBI has clearly supporting this transmission as well. We've seen them focus on liquidity measures. They've been actively infusing liquidity in the system all through and through. There is every reason to believe that rates will head downward. The little bit of risk that always emanates from currency, I think that also looks a little low presently. With the dollar looking to weaken, there is no reason why the rupee should sharply depreciate from here. Also, if you look at another factor, if you look at the fact that the rupee, if you look at it, it's actually depreciated relatively in the recent time, in terms of real basis, where it was hovering to close to 108 levels at the end of last year, is close to roughly 102.5. So actual effective valuation of the currency has also come down. So I think the rupee is going to find support here off and should be largely stable, which means investors investing in India should find that a rewarding trade. And they should look through the noise and invest for the longer term over a year plus. And I think they could be handsomely rewarded for that.
Thank you so much for that in-depth analysis, Tanveer. And thank you, viewers, for tuning in. I hope you enjoyed this conversation and was an informative one for sure. Stay tuned to Kotak International. We'll be back with more.